Hello, and welcome to this discussion in which we consider the long-term influences on investments. A huge amount has changed over the past 12 months. The politics of populism have shaken the established order on both sides of the Atlantic. Despite predictions of woe, stocks subsequently hit sustained record highs, and the outlook for inflation and growth has been adjusted upwards in anticipation of President Trump's plans for growth. The US president has pledged to inject hundreds of billions of dollars into infrastructure spending, radically overhaul the tax regime, reduce banking regulation, and impose trade restrictions with a view to boosting domestic employment and growth. Mr. Trump has already withdrawn the United States from the Trans-Pacific Partnership and has promised to implement a more stringent immigration policy. The advent of Mr. Trump's policies has significantly boosted already rising expectations of inflation growth and, with it, rising interest rates. We're facing a period of change and unpredictability. How many of Mr. Trump's pledges will turn into policy? How will trade restrictions affect countries outside the US? How will inflation rise? And what is the longer-term outlook? What sort of divorce will the UK negotiate with the European Union? And how will all of these factors affect the outlook for economic growth and investments? To answer these and other questions, I'm joined by the Chief Investment Officer of Lloyds Bank Private Banking, Markus Stadlmann. Thank you for joining me, Markus. Taking into account the factors that I've touched on just now, what would you say are the prospects for economic growth?
David, very briefly, we are in a very healthy situation with regards to economic growth. As we look forward towards the next decade of investing, prospects in a number of countries are really very bright. On the risk side, we need to consider the geopolitical events of 2017 and further out. Obviously, we know we are on the journey to Brexit for the UK. There are a number of other very important political decisions which will influence investments over the coming years, which we need to consider. Another key factor is that interest rates are really low and will stay low for a while. They will go up in some countries, but they are nowhere near where they should be in terms of a normal economic cycle. And finally, we should consider how asset classes are being valued. And it's probably fair to say that returns from a few asset classes will be lower than the long-term average we've seen in the past.
Let's talk about one of the areas of risk then. US President Donald Trump, he's going to be around for at least 4 years, possibly 8, so it does have a bearing on the long-term outlook. He's made it clear that he wants to put America first by bringing manufacturing onshore, restricting immigration, and maybe imposing some trade barriers with a view to boosting domestic growth in the US. He's also been critical of Europe and China, accusing them of manipulating currency rates so it makes their products more attractive in terms of price terms to US consumers. How do you see the actions of the new US administration affecting the global economy?
We need to separate the political noise from the facts that investors really need to know about. And two elements of the Trump set of policies are actually quite positive. One is corporate tax reform. That is long overdue. Since the 1990s, corporate taxes in the US haven't changed, and they need to adapt to the new economic regime we're operating in. And number two, infrastructure investments. It's really important that the US goes back to the 1950s, 1960s level of investing more money into hospitals, roads and airports.
Let's come closer to home then. The big question mark over the UK and Europe is Brexit, and that's going to have implications not just economic, but also inflationary. Talk to me about that.
That's a key factor of our outlook, David, inflation. Everybody expects a change to inflation coming from the weaker pound, i.e. input prices rising over the next 12 to 18 months as a consequence of the pound trading at much lower levels versus the euro and the dollar. So that's clear. What's less obvious and is frequently overlooked by investors currently as they look forward for several years is the structural change that's happening in global inflation. Global inflation is becoming more pronounced because spare capacity is gradually receding and will completely go away in the near future. And I think for a number of years, for the entire 10-year outlook, in fact, inflation might be significantly higher than current inflation swaps and interest rates imply.
Okay, let's look further afield now. China, the world's second largest economy, whatever it does has an influence on the global economy. And as we know, it's now rebalancing its economy away from the triptych of infrastructure, manufacturing and export that's propelled it to prominence over the past 15 years. It's now moving its focus towards services and domestic customers. In your opinion, how successful has it been in doing this, and what would you say are the implications for global growth?
China is succeeding, but at the same time there are a couple of challenges. Let's talk about the risks first. Debt in China has been rising significantly over the last couple of years, and if you look closely at that debt, it's largely state-owned enterprises who have taken on a lot more debt than before. It's not worrying at the moment, but it is something that needs watching, and it is a risk that ultimately this will become unsustainable. A second element to consider for long-term growth in China is demographics. As we all know, China applies a one-child policy and has done so for a number of years now, and that means that population growth will decline substantially in the next 10 years, and that is a concern because population growth supports economic growth.
One of the factors of Chinese growth is the Chinese middle class, which is growing at a great speed and will have massive implications, not just for China, but for the rest of the world. So talk to me about your understanding of what's happening there.
This is exactly the big good news story about China going forward. The Chinese middle class is expected to grow to about 550 million consumers, which will have a hugely positive effect on the global economy, since for that reason consumption in China is expected to grow, we think, by 9% per annum. And just to put this in perspective, this means that an additional 90 million consumers will enter the middle class over the next 10 years, and that's obviously more than the entire UK population. I think that tells you how significant that transition of the Chinese economy and beneficial for the global economy the Chinese story actually is.
Okay, let's turn to emerging economies and markets. Talk to me about how you see that fitting into the future.
David, first I think it's important to emphasize that emerging markets is a catch-all term that includes countries in very different stages of development. Just to give you a couple of examples, Argentina is under new leadership, has been for a while now, and is turning around its economy. We have India, which is a long-term success story, lots of economic reform happening there, and the booming tech sector. We have Russia, which is too reliant on its natural resources, and the political leadership is difficult, to say the least. And then we also have Turkey, which already has been through political turbulence a lot. So these four examples bring home that we need to be very differentiating in which countries to invest in. And therefore, the starting point of our investment considerations for the next 10 years in the emerging markets world is to look at the various countries, consider political, economic factors, look at the stock market, look at bond markets there, and be very, very selective in where we do invest for our clients.
So what does all this mean for investments?
The key term, David, is robustness. We have a positive outlook. We have geopolitical challenges that will occasionally dominate financial markets and lead to volatility, which means that for the long term, we have to build portfolios that are robust enough to sail through those challenges. That means keeping the fluctuations of portfolio values to a minimum.
Markus, thank you very much indeed for your time, but that's all there is time for now. Thank you for watching.